All right, it's Friday. Welcome back to Stock Market Weekly, your 20-minute show catching up on all of the notable moves across financial markets. I'm your host, Evan Medeiros. We publish these shows every Friday, so make sure you tune back in on the weekend to prep yourself for the week ahead. This show, I think, is going to be pretty short because there wasn't a whole lot going on. It was a holiday shortened week, 3.5 days of trading, light volume. I think there are a few things that we are still grappling with in this market, and it's sort of the only things that matter right now. It is Treasury Yields, which continued up this week, third week in a row. We're not quite back to the highs from March of this year, but or April, but we're pretty close. The 10 years at 4.62%. I think we were year to date was 4.7, I think, at the highs. And then back in 2023, we almost hit 5%. So we're getting back up to these nosebleed territories, and it feels like the equity markets are still slow to react. We obviously saw a little bit of a sell-off reaction on Friday of this week, but we grinded up to start the holiday week, and then we sort of gave the bulk of it back on Friday. So that, I think, is still pretty much front and center. You can tie, economic data, inflation data, jobs data, all to this, outlook on what the Fed is going to do and how the Treasury market is going to react. But I think that's the big story right now. So that's what we're going to talk about. We're going to look at the latest data here. And before we get into it, I do want to shout out our sponsor, Investors Business Daily, for making this show possible. They've been supporting the shows for a while now. We've got links in the description of this video. They're actually printed right here as well. Two products, Market Surge and their IBD digital subscription. We've got links for both of them. Check them out. They're both products that I use every day. And now let's get into the show. All right, we're back. We've got some charts in front of us. Speaking of products and platforms we use every single day, this is Warden TC2000. It's what we're going to use throughout this video. It's a platform we support here at the Trade Risk as well. If you're a trader that's a little more tactical, active, short-term, looking for responsive stock scans, curating watch lists, this is more the product for you here. We've got a referral link in the description of this video, and we've got lots of cool things built on our website at thetraderist.com for your trading pleasure. All right, so let's get into the numbers here. Right hand side, you can see green week across the board. All the major indices were up this week. That was nice to see. And hey, we're at the end of the year. It's wrapping up 2024. If we take a look at the 1 year performance, take a look at this. This is a 1 year look back, so it's not quite year to date. It's off because it's pulling in a couple of the last days of 2023, but you're seeing basically the numbers here, 25% for the S&P 500. That's a very, very solid, good year for the stock market. Nasdaq up 27%, Dow Jones up 14%. Russell 2000 was the laggard, gave a lot back here over the past month, up about 8.5%. So all in all, and a real spectacular year for U.S. equity markets. And hopefully everyone was able to enjoy and participate in a lot of that market rally. If we take a look at volatility index this week, everything was down. So a couple points coming out of the VIX, Nasdaq vol, S&P vol now going back to about 16 and change. So a little subdued. It upticked on Friday, but still coming out over this week, which was nice to see. Now, if we take a look at sectors here, we had some winners this week. Healthcare led the charge, up 0.7%. It's been a tough spot to be, so nice to see some buyers kind of stepping in here and bidding. Technology, strong group recently, continued to be strong this week, up 0.65%. Energy had a nice little bounce back as well. It's been a real tough spot, up 0.5%. On the downside this week, consumer staples, materials, real estate, those were the three hardest hit. You can see the 1 month returns here. You get some almost double digits plus and minus. So it shows some of that volatility that has been in the market, some of the dispersion in the market over the past month. And if we look again at the 1 year returns, you can see we had had some big bright spots, and a lot of the market had some bright spots, right? It wasn't just technology. Technology was up 23%, but financials were up huge this year, up 29%, discretionary up 27%, communication services up 35%, utilities were up 20%. So there were some big winners this year across the different sectors. Really, you had to kind of avoid energy, which was flat, and then you had materials down 1%. So not a terrible year in those two sectors, but certainly lost a lot of opportunity cost if you were overweight energy or materials. Let's take a look at our sector trends here. It's not looking too good on the daily chart, right? There's no other way to put it. If we look at our smart trend filter here, this is an indicator for TC2000 and TradingView users. You can get it on our website, but let's see, everything except for, this is going to be the easier way to say it, technology and consumer discretionary is in a downtrend. Tech is technically, green to yellow. Same thing with consumer discretionary. Everything else is in a daily downtrend now, printing red dots here. So that goes to show you the environment that we're in, the damage that we saw last week. Remember, the title of last week's episode and the real takeaway from last week's episode was a week to take notice, a potential topping signal, a changing of regimes for the stock market. Okay, not necessarily some big grand, secular top to a bull market. We're not calling anything like that. We're just saying that, expect things to get a little bit rocky here over the next several weeks, maybe a month or two, right? That's what we're looking at. That's what we're kind of sniffing out here. And we're going to talk a lot more about that throughout this video. If we take a look at market breadth, this is another thing that we were really sort of keying off of last week. And what we saw was the highest number of stocks hitting 52-week lows last week that we've seen pretty much all year long, going back to the end of 2023. So that had us getting a lot more cautious too. Take a look at the number of stocks hitting 52-week highs. Those have basically dried up and are non-existent, let's call it. And we're still seeing plenty of stocks hit 52-week lows. So this ratio is tipped to the bearish side. It's what you really don't want to see if you're intermediate term, say, bullish on this market. These things can come in waves, right? It doesn't mean this has to persist for a very long, prolonged period of time, but maybe this persists for a couple of weeks, right? Maybe we get a 5 to 10 or 7 to 10% pullback here in the market, and we have, a few weeks of turbulence. That's what this is at least showing us right now. So I still don't like the look here. It can change, but for now, continues to be in the bearish camp. Now, if we take a look here at our macro slide, dollar index in the top right, unfortunately this paid a distribution this week, so you got to be careful on this chart. It really wasn't down this much. That would probably be great to see, although I don't know if that'd be great, because that would suggest something big had hit the market here. But dollar index was I think it was still up this week. It was still slightly up this week, but because this paid a distribution, we're going to have to ignore it this week. If we take a look at the 10-year Treasury yield, this was up again, continues to ratchet higher here. This is what we led, kind of the opening video with of the point of concern for this market. We're almost back to the April highs. We're not quite back to the cycle highs, but this is getting quite elevated here for stocks to digest and chew on. Again, it's rate. It's also rate of change. These things matter, and the uncertainty behind the Federal Reserve and their policy or their rate decisions next year is certainly leading to some of the discomfort here. Let's call it or uncertainty. So 10-year Treasury yield continues to move up. Oil was up this week. Copper was up slightly. Gold, silver, Bitcoin, all down this week, about 1% or 2%. All right. So let's get into some of the price action. So last week, again, we can watch last week's video, but we talked about the very heavy dollar volume, the outside reversal week, or just the bearish week that took out several lows. And the S&P 500, just generally speaking, this day here specifically was the day to take notice. That was Fed day, and we really did wash out sentiment pretty nicely. We looked at some of those other market internal metrics last week, and it paved the way for a several day bounce this week. Again, it was a holiday shortened week. Volume was a little bit lighter. This is generally a bullish time, especially as markets are up 20+%. You usually get a nice kind of rally around this time, and we got it, but we did give some back here on Friday. It happened to be the heaviest volume day of the trading week as well, and we gave back 1% in the S&P 500. Now, if you recall, one of the roadmaps, sort of the game plan from last week when we talked about the S&P 500, we said, kind of exactly this scenario. We said, look, it wouldn't be that surprising to see a kind of a low volume bounce here up to around $600 in the S&P 500, put in some type of lower high, and perhaps that starts the move, the second leg lower down into the mid to upper 500s, right? That was kind of last week's game scenario planning, right? I don't want to call it a prediction because it's not a prediction. It's really just keeping an open mind. It's having the advanced knowledge of sort of the if-then scenario, so you can, not be caught flat-footed, right? Not be caught surprised when you game plan some of these things. So we got a nice run right above $600 here in the S&P 500, and then we pulled back fairly aggressively on Friday. Now, again, we don't know if this second leg lower is going to happen. We could project a move, and we could say, you know what? Let's say if this move, just like the first one here, we sold off 4.5%. I'm going to round here, but if we sold off 4.5%, we would come right back down to, let's call it about 570, 575 in the S&P 500 if we made kind of a second leg lower here, right? So we had this leg lower, and if we basically had just another measured move, we'd come right down to about here. Again, not a prediction, just keeping an open mind. That would coincide roughly with a gap fill from the election, post-election, and that would bring us comfortably back into the range here from October-November timeframe, and then that would put us at about a 6% correction from all-time highs. It sounds extremely reasonable to me. In fact, that wouldn't even really disrupt anything on longer term or even intermediate term trends, quite frankly. We would still be in a pretty healthy position. If you just look at a weekly chart and you imagine us coming back down to about 570 or so, then it doesn't sound all that unreasonable, especially given the 25% plus year we've had in the S&P 500 without any 10% corrections. Let me make sure that's true. I don't know if we had a 10% correction in July. I don't think it was. It was pretty close, but not quite 10. So that's, just again, another realistic sort of game plan roadmap looking ahead. Like we talked about, though, we could, work off some of the ugly breath and some of this, heavy outside dollar volume, this washout here. Maybe we work it off sideways, right? That is absolutely another possible scenario here where the market just kind of bounces around. Maybe we fill this gap and we just go sideways between 577 and 608 for the next month, right? And we just work off those oversold conditions, bad breath through time. And maybe at that point, the dollar starts to roll over. We get more clarity on the Fed, and earnings season begins, right? So these are things to think about. I do still think that last week was a bit of a regime shift, and we do need to see more evidence of stabilization. Friday was a rocky session. Let's see how we start or finish off the end of the year and then start off the new year, which is what we're going to start to see next week after the holiday. So we get another light volume kind of holiday shortened week next week, and then, off to the races starting January 6th will be our first full week, and I think that'll start to really set the tone of how this market's going to start 2025. So S&P 500, watch out for this lower high scenario and watch out for a second leg lower. I still think it's probably the most likely scenario, but again, one day at a time. If we take a look at the Qs here, you basically have the same thing. This looks better. Technology has been relative strength kind of winner here. And I would say from an intermediate term perspective, if you're thinking about risk management, 503 or so. There's plenty of good evidence on the long-term or longer intermediate-term case to really still do nothing here and to let this, pullback, shallow pullback, this correction take place. If you're a longer-term investor, you don't have to panic and worry about every little move. If you're short-term and you're active and you're looking to manage risk, or you're certainly looking to capitalize on these types of movements and volatility, then, you've got more things you can start to do about now. But Qs, again, wouldn't be surprised if this is a lower high that we just put in here and might start that second leg lower. All right. Russell 2000, certainly looking a little bit weaker here. Could be setting up some type of bear flag. Again, we talked about this below 225 or so is just, kind of not a great place to be. We're kind of bear flagging right into this. So if we start to break down here, that's going to be troublesome for the Russell 2000. It's going to give up a lot of its, nice run that it had in November and towards the end of this year, and it's going to start doing more technical damage. So my excitement on the Russell 2000 is certainly much lower here unless we can push through this 225 and start holding to the upside. So that's really kind of the high level of what I'm looking at. If we look at, say, IEF, I mean, we already sort of looked at it with the TNX earlier, but this is the 10-year Treasury bond fund. You can see this still looks pretty heavy. I mean, it's extremely oversold. It's a little bit long in the tooth here, but, technically just isn't that pretty right now. So we need to see some type of reversal. VIX we talked about back down to 16. It popped up a little bit towards the end of this Friday at the end of the week, but keep an eye on this. If we do get that second corrective leg lower, then I wouldn't be surprised to see this push back up towards 20 either. And I think that's kind of everything. I mean, I don't really have too much else to add. Stocks all sort of mixed this week, depending on what you were looking at. They had some big gains at the start of the week, gave it back on Friday. Bitcoin, we can take a quick peek here. So that's back down to about 94 and a half. We talked about last week opening up the downside to about 85 or so. I still think it's potentially in the cards. It'll be interesting to see if Bitcoin could diverge here a little bit. I mean, there's lots of corporates now that are starting to aggressively add, and you're seeing more and more companies come out and put this on the balance sheet and kind of, help prop up this market right now. So it'll be interesting to see if there's enough buying pressure to offset some of those macro headwinds. If we can hold above this 93 and we don't start breaking down this cluster of recent lows, you can see it's trying to hold in here, then maybe you just, kind of continue to chop around in this nice tight range, call it between 93 and 104 or 102. And again, maybe it works it off sideways, but it still would not surprise me to see some type of wick back down below 90, and we'll see if the dip buyers come back in on Bitcoin. All of our trend models are still engaged here, so again, timeframes matter. Whether or not you need to take action is definitely going to depend on your strategy and your time frame. So I want to finish off here with our trading systems, because hopefully this gives you a little bit of color and insight into what we're doing, and maybe this informs your trading at a high level. We've got 3 trading systems, of course. They were net sellers this week, so they brought down exposure. The markets were rallying at the start of the week, and our trading systems, we're basically selling into that rally. Our short-term system made 13 sales, and our medium-term system made 4 sales. So 17 positions sold this week. And if we look at our exposure across these 3 trading systems, we were heavily long, again, on margin, borrowing cash to participate in this uptrend. That's the position that these 3 trading systems were basically in coming into last month or so, or into December. And you can see that this is now paired down. Our short-term trading system is 48% long right now. So it's basically got cash reserve. It's not short anything, but it's taken down that exposure pretty dramatically this week. Our medium-term trading system is at about 87% exposure. So it's raising cash pretty aggressively again. That was on margin, sort of borrowing to, have extra capital in the market. And you can see just, again, the shorter-term systems are getting more defensive. Medium-term system raising cash, getting a little more defensive. Our long-term trading system still doesn't care. It's 119% long right now. Some of that includes Bitcoin and alternatives, but that system isn't really flinching right now on this type of pullback or the volatility that we've seen. So if we look at all the exposure across, we're about 85% invested. Rules-based trading systems are all on a swing or longer time frame, and you can see basically the de-risking happening this week on our short and medium-term systems. All right, so starting to take action. We post our performance every single month, and these are available for trade signal services. for the new year, if you're interested, if you're looking for some better ways to just manage your own trading accounts or get some inspiration, then we welcome all traders, discretionary, system traders, and everything in between. So that is it for me. Hopefully you had a wonderful holiday time and got some time away from markets. And Happy New Year. Thanks so much for tuning in. Thanks for making all these shows and tuning in every week. Something special for us. And we appreciate it. And we hope to see you back here in the new year. Take care and have a good weekend.